site. In the meantime, let's go to a veteran money manager. He's also our featured guest of the morning, John Zechner, chairman and founder of Zechner Associates. John, great to have you with us. Thanks so much for sitting in today. I know you've got lots of thoughts on this, as always. Let's begin by listening to some comments made by Susan Collins yesterday. She's president of the Boston Fed.
In my view, this transition to a more patient approach, taking the time to holistically assess incoming information, was warranted for a number of reasons. In particular, it reflects the fact that we're likely very near and perhaps at the peak for this tightening cycle, with the risk of inflation remaining persistently high more closely balanced with the risk of slowing activity more than needed to achieve price stability.
So, John, is some interesting comments there. Right in the middle, she referenced the notion that perhaps we are very likely near the end or perhaps at the end of this tightening cycle. How would you interpret those comments, and do you agree?
Well, you're absolutely right, Paul. And we have seen that. I think that's why the stock market has rallied probably in the past week, is you're starting to get slightly more dovish comments out of some of the Fed governors, hinting that, yes, we are, if we're not at the peak, we're close to the peak. Today's numbers, as you mentioned, are going to be very important in determining, the forward path and how long they have to keep these rates at these levels. But yeah, as you mentioned, 3.5% to 4%, or 4% core inflation is a long way from the 2% target. And I think the reality that had the market weaker for a lot of the, the second and third quarter was the idea that, it's going to take a while to get down to those numbers, and we're going to have to leave rates here. At the beginning of the year, the expectation was that they'd be cutting rates by the end of this year because of economic weakness. Clearly, it hasn't developed along that path. Economic growth has stayed stronger for longer than expected, maybe too much residual strength in the system from pandemic spending and other things. And so we're all sort of on watch. The Fed's on watch. Everybody's sort of keeping their eye on it. The only thing we know for sure is they seem determined to get to this 2% target, or on a clear path towards it, and we're not there yet. So, the market's going to have to take it in stride. But is the worst over on rates? Maybe that's what stocks are celebrating a little bit in the past week or so, particularly growth stocks.
What's your take on what bond markets are signaling? A big concern for investors not so long ago was the big run-up in the U.S. 10-year and other bond yields, as the bond market seemed to be forecasting a period of higher for longer, a stronger than expected economic activity, and a longer battle against inflation, at least higher for longer rates.
Well, you're right, Paul. And the bond volatility, which has increased dramatically, we could be on our way to 3 years of negative returns in the bond market, which is unheard of, has really been driving the stock market. Like we said earlier, it's all about the macro. It's interesting. The bond story, particularly in the past couple of months, is less an economic strength inflation story going forward and more a supply demand issue. Quite honestly, the problem has been is you've lost the four biggest buyers of U.S. treasuries out there. The Fed has gone from quantitative easing to quantitative tightening, meaning they're going from, buying $100 billion a month to selling similar quantity. Japan and China central banks are no longer buying, and they haven't really turned seller. And the chartered banks across the country, because of SVP, the Silicon Valley Bank, it just shows you what can happen when these banks carry huge amounts of treasuries at much lower yields. Bank of America, what is over 100 billion of treasuries, losses on the books right now that they haven't realized. So all those buyers have disappeared at the same time, where because of deficit spending, they increase for the back half of this year the need to go to the market for treasuries by over $300 billion. So that is simple supply demand, and that's what's driven the yield up. And to attract that capital to fund these deficits going forward, you're going to need higher real interest rates than you've had in the U.S. for a period of time. And I think that's what's driving the negativity in the bond market, and why you've seen some shorting there, and why you've seen the term structure change a little bit. It's an interesting story, Paul. It's more than just the economics and the inflation right now.
And so with all those forces combining to push bond yields up, what is your forecast for the next year, let's say, on equity markets?
Well, we're getting a little more positive on equity markets, Paul. I've been adding. We were at maximum cash into, throughout the summer, and we have been adding back. I just tend to think, the market's been in a trading range for 2 years, and I think it's more likely that even if there's bad news ahead of us, we're seeing the peak in interest rates. It's the most expected economic slowdown ever is sort of in the headlights. A lot of stocks have already discounted that, and I think if we finally break out of this 2-year trading range, we'll break out to the upside. It may not happen right away, and there's bad news in front of us, but we've been putting money back into some of the growth areas of the market because I think we really have seen the peak in rates. I think you're going to see much slower growth, so the cyclical stocks will have a tougher time, but the growth stocks, like tech and others, telecom, utilities, will probably do a little bit better, and that's where we've been putting more of our money in the past month or so, using some of this excess cash reserves and adding to bonds, Paul. I mean, I tell you, 4.5% to 5% 10-year U.S. Treasury, that to me seems a bit of a gift, even in that supply-demand situation I described earlier.